52s. It's just traded 52s. So the sell trade off the 62 level has also done $1,000. So you could say, well, that's me, I'm finished for the day. I'm going to close that trade off now. I'm quite happy with my $1,000. And instead of a $500 trade there, it's actually a $1,000 trade. And you can say, that's me finished. I'm happy with my day. That's what your final outcome is, guys. That's what your final profit and loss is for the day, based on single contracts. 2 lot trade entries. That's what you would have ended up finishing with on gold. 1,000, 2,000, 3,000, 4,000, 4,001, 4,002, 4,3, 4,4, 4,5, 4,6, 4,7, 4,8. $4,800 profit on a 2 lot. So I'm assuming every single gold trader beat those numbers quite substantially, of course, because we're only doing very, very rigid, very, very fixed entry processes. We're not trying to manage in and out. So every single one of you must be doing better than $4,800 today. If you're not, what the hell's wrong with you? You can't even beat a systematic approach to trading. Why can't you beat a systematic approach to trading? Everybody should be able to beat a systematic approach to trading. It's the worst approach to trading you can get, is a systematic approach to trading, because it's just a system. It's a very rigid, very inflexible set of rules. You should always be able to beat that, surely, right? Right? So everybody that trades gold should be well over $4,800 profit on a 2 lot. If they're not, they shouldn't be trading manually. They should be trading systematically, because if the system beats you, what the hell would you try and beat it for? You just trade the system. And when you trade the system often enough, guess what happens? You get better at manually trading and manually overriding the system. You get better. You maximize. You saw us taking, for example, you saw us taking some profits when we hit that $2,000 level. Now, if I'd left that, of course, at 76s, it's just traded 52s. We could have added $2,400 instead of $2,100 to the value. But at some stage, you've got to take some profits, right? You've got to be managing out maybe a position. So on that basis, we are now completely and utterly flat gold. And all we've traded is we've traded that short trade, we traded this long trade, we traded that short trade, we traded that short trade. I didn't include this one because that's the one we did in the class earlier. We did that one because we just said, you know, you could trade volume anywhere, but that wasn't part of our systematic process that we were talking about. So we traded this one, we traded this one, we traded this one, we traded this one, and we traded this one. We broke it down into 2 contracts. Some of them are 2 contracts, so that's $100. That's $100 plus $10. That's $1,100. That's $1,000 plus $100, etc., etc., etc. And you can see that that's $4,800 on a systematic trade process. Now, a lot of people wonder why would you ever trade systematic when it's not as good as trading manually? Because sometimes a system beats bad traders. You should never beat a good trader. This should never beat you as a trader. If this beats you as a trader, that's what I'm saying. You're not a very good trader because you're not doing as well as a simple, robust set of rules. It's like saying the MACD divergence is your buy and sell triggers, and that's it. That's all I'm using. If you can't beat that process, you must be doing something wrong. Understand? You've got to be doing something wrong. You've missed the breaking trades. You've missed the breakout trades. You've over managed it. You've over analyzed it. You've overthought it. You've over elaborated your process, perhaps. But you should never be beaten by a systematic process that simply is just a buy side, sell side level. Come on. You might be saying, but that sell was random at the top. It wasn't random, was it? It wasn't random at the top edge. It was actually a high volume, the highest volume of the day in the London session. That's why we put it in. But it's not just because it was the highest volume of the day in the London session. It was the highest volume of the day in the London session, and it was $1,000 higher than the London Open. That's why we put it in. In other words, there's reasons, not just a random decision. You may be saying, well, how do I, as an afternoon session trader, how do I pick up on this? Well, you could have picked up the sell at 2 o'clock, where is a buy-side, sell-side level. And how could you pick up on it if you haven't got anything on right now? How could you trade this if there's no particular view? Well, you simply try and find something that you like. Something that you like, what does that mean? Well, what about the 1750 level, for God's sake? It's not that hard. So if I said to you, right, well, let's do an RGL level. Let's think about a possible RGL level. I'm going to do 1750 and a half, and I'm going to do 1749 and a half, and there's my RGL right there, right? There it is. If it goes into 50 and a half and comes back out, I'll buy at 50.6. If it goes through 50, if it goes 49 and a half and it sells off, I'll sell it below the bottom edge and I'll start the RGL all over again. What happens if the price never trades 50 and a half? Well, that's up to me. That's up to me, isn't it? I can now go into this and say, right, well, I could do an RGL from anywhere, couldn't I? I could literally do an RGL from anywhere. So I could look at the volume and I could ask the question, well, where's the big volumes? Where's the big volumes? Well, the big volume is really this crappy little stunty candle just here, isn't it? Right there. So that little stunted candle just there, I'm going to be looking at that. What was the high price? 54.7. Okay, 54.7. I know where my RGL is. If the high of the candle's 54.7, I'm going to put my RGL at 55. So I'm always going to be rounding the numbers up, right? The low of that stunty candle is 51.7. Now that's a bit big now, isn't it? That's a big candle. If I was to put in a sell at 51 and a half, for example, I'm going to be using a 35 tick stop. So that's a little bit too much, right? So because that was a high and because I had a big pin rejection and because the market's selling, I would rather be short than long, right? So what I could do is I could do 55s and I could do 54s. I could do 53 and a half. I wouldn't normally do more than 15 ticks on a trade like this. So that would probably be my RGL based on that volume. See how the pin is into that RGL just there? See how the pin's into the RGL? So I'm using the RGL as a price action. That's what I do when I do RGLs. I use the price action so that I try and stay with the market. Try and stay with the market. Now, if I did that, how would you have traded this so far? If I did that as an RGL, how would this have traded out since then? Well, let's take a look at what trades would have been taken on this so far. Okay, so the first trade we would have had is obviously this green candle. Well, it's not the green candle because it goes up into the RGL. When it breaks the low here at 53 and a half, obviously I'm selling that price, right? 53 and a half, and I'm looking for 52 and a half. Well, you can see it trades 52 and a half. So if I was trading this as an RGL, my first trade is already plus 10 ticks, right? I've already got 10 ticks in the marketplace. Now, based on that first sell, and the first sell would have came in just at this price here. There's my first sell trade there. Obviously, the second trade gets scratched out. The second trade gets scratched out, so a zero. So I get plus $100. I get plus $100, and I get plus $10. Okay, so I'm now up $110 on that trade. That's it. That trade's finished. You may be saying, but the price broke south here. Yeah, it did. So you're short. Good. Well done. Great spot, guys. Woo. So you're selling it, right? So you're in it, and it goes up. And what? Nothing. Nothing. You're still in a trade. Did you get a sell trade? Did you get a profit take? Well, probably not. 53 and a half down to 52 and a half. It's probably came up shy of a profit take. But when the price breaks out this time, it easily goes down to 52s. So you easily get your $100 back on the trade during the break south here, right? During the break south on this candle here, it breaks south. So that's another $100. You're just getting another $100 into that phase. So there's your next $100, and that's on that sell arrow just there. And that's on this candle. When the price comes up, you can see it never goes back inside, so you never get scratched, and it comes down, and then you do get scratched. Now, you might be saying, What happens if that trade scratched me out? Well, if that trade scratched you out, you make more money. That's what would happen. Which you mean I would make more money? Because you would obviously have put a sell stop order back in again at one tick lower. So it doesn't matter, but we won't cherry coat this and make as much money as we could have been making, but you get the basic idea. We could have had another $100 profit. When the price comes back up, we do get scratched out at plus 10, right? We do get scratched out at plus $10, remember, not 10 ticks, $10, plus 1 tick. So you were saying, but okay, so what happens next? Well, we sell it again. When it comes back out, we sell it again. And what's happened since then? We make $100. That's what's happened. And what's the current trade? Well, we're short, and we've got a break-even stop. That's what happens. So since this phase has taken place, since we got that huge volume pin rejection candle here, which would be buy side above at 55s, sell side below at 53.5s, you could be making $320 so far. And obviously the sell trade that's in just now is at 53.5. The current price is at 50 evens, so you're up $350 on your last outstanding single sell contract. Can I assume everybody's outperformed this process so far? Can I assume everybody's made more than $500 from that sell phase? If not, why not? Why are you not able to outperform a robust, simple, systematic process like this? How can you possibly not outperform that? You must be able to outperform these ideas, shouldn't you? You must be able to do it. Otherwise, why don't you just do a systematic process? Why don't you adopt a systematic way of trading? Because your trading isn't as good as a systematic process, and therefore you're better adopting a systematic process. It seems only reasonable to follow through on that. We said this, I think it was a question a long time ago, and I can't remember who it was asking. I think it was Abraham actually a while ago. Why is my trading not as good as a systematic process? I think is basically what he said, and this was months ago when we touched on RGLs. And that's an absolute, it's a great realization when you think about it. Because if your trading isn't as good as a systematic process, you should be trading the systematic process. And you should be building out a knowledge of how to properly manage out your expectations, but let the system take some of that stress, because there is no buy trade up here at this moment, is there? You may be saying, well, what happens if the value goes dead bullish? Well, guess what, guys? See if the value went dead bullish, what could you possibly do that could possibly help you? Come on, seriously. What if the market went dead bullish down into this area? Well, put your RGL in as a buy trade then and start working the buy side, sell side RGL at the bottom edge. That's what you would do, wouldn't you? So you can see there's a very, very large candle just here, a very large candle phase here. And you say, right, I'm only going to be buying this at this point. I'm only going to be doing business at this point. Now, this is obviously taking into account that there's a big 50 wholesale price here. So the volatility is going to increase at this point. So realistically, you want to make sure you give yourself enough room to maneuver around the stops. So if I was trading this, if I was only bullish, I would put a buy order in at 50.5 and I'd probably give myself 15 ticks. So I'd do 49s to 50.5 if I was trading this, because I'm wanting to take advantage of the stop liquidity, right? My intention is not to sell below this level. My intention is not to sell below this. So if I wanted to just buy above this, the first trade I would have had was a buy trade here at 50.5. The 50.5 would have closed off the sell trade at 53.5. So that closes off that for $300, right? So that trade is now closed for plus 300. If I've closed that trade for 300 and I'm now long the market and I'm in at 50.5, the first trade rallies to 51.3, so I don't make any money. I don't have my stops at break even. I'm in a long trade. The trade trades back down, doesn't stop me out. Trade trades back up, and now I get $100. Now I've got a $100 profit because the buy trade on 2 contracts has taken out 10 tick profit on that deal. Now I'm in a long trade. My stops are at break even at 50.6, and that's it. That's it. That's the trade. I'm now in at 50.6. There's the trade right there. So I am now long, and I'm not trying to be short. I'm just now long. For how long? For how long? Well, for as long as you want to be long. I mean, it's up to you. But at the end of the day, you could say, well, I'm going to be long until the value changes. I'm going to be long until the value changes. I'm going to be long until I get $1,000. I'm going to be long until I see a huge absorption volume contract that I can lean against. It's the same thing, isn't it? Is it not the same thing? I think it's the same thing, guys, is it not? So this is it. This is the process now, isn't it? This is your process. So you're now long this market. There's your RGL that's came in because of the wholesale price. And as I said, if you only wanted to be bullish, you don't have to be bullish and bearish, as I explained to Alec. You could just be bullish. If it goes above, you buy it. If it comes back down, you scratch it. If it goes above, you buy it. If it comes back down, you scratch it. If it goes above, you buy it. If it breaks below, nothing. Nothing. You have to now come up with a new idea, don't you, if it goes below? That new idea could be a lean at a lower price, right? So you start seeing the process evolve. You start to see that process evolve very easily. So when I'm talking about this idea of if you're bullish the market and the price comes down and you head into a great level and there's huge volume on this, imagine you were trading this from the perspective of a systematic trader. And you say, right, there's huge volume coming in this candle. It's on a downtick and I'm bullish. The values are way up here. I'm bullish. Okay, so I'm going to put a buy order in here and I'm going to put my stop in here. The market breaks. I'm now in a buy trade. I'm now in a buy trade, right? So I'm in a buy trade and the price goes up. I get my first target price and I get my stops at break even. The price comes down and stops me out at break even. And the price drops. And the price comes back up and it gives me another buy trade at exactly the same price. And it comes up and it gives me a target price and I get my 10 ticks target and stops are at break even. And the price comes down and I get stopped out at break even. And the price breaks. Well, I'm not in any trade now, am I? But guess what? I've now got the ability to watch this. And what happens if we see this happening? What happens if we see this? The reason why we bought that was because we saw that huge volume candle coming in there. And then the volume did this. And then we saw this volume candle coming in here. And then it did this, perhaps. Well, if the volume candle comes back in again here, what could we do? Well, it's very simple. I could simply then say, right, I'm going to take another buy opportunity. I'm going to do another RGL here, and I'm going to start the process at a lower print. Understand? And then you start buying, and you go, there's my buy trade. I've got my 10 tick target and I'm putting my stops at break even. Shit, I get stopped out at break even. And the price comes into the value and it comes back up and you go, right, I'm buying it here. Oh, brilliant, brilliant, brilliant. Target price number one, $1,000 target price. And there's your opportunity. So in other words, you would have traded that like this, wouldn't you? You'd have traded a buy trade here. You'd have traded a buy trade here. You'd have traded a buy trade here. And you'd have traded a buy trade here. That's systematic process of trade, isn't it? That's a systematic way of looking at trading. Every trade is a system. Every trade is a process. Every trade has the same entry mechanism, doesn't it? Well, is that not what you're supposed to be doing manually? Is that not what you're supposed to be doing manually? Because why did you mark off this area in the first place? Because there was a big volume lean. Is that not what you're supposed to be doing, guys? I don't know. Is that not what you think you're supposed to be doing? Maybe you've misunderstood the whole bloody course, but is that not what you're supposed to be doing as a trader? Is recognizing the commercial activity, leaning against it, and buying it as it goes away from that lean. Does anybody think that we teach anything different than that? Anyone? That's exactly what we teach. It's exactly what we teach. In other words, it's a systematic process for seeing a commercial activity and then leaning against it as a local, isn't it? That's all it is. So that big volume is a level. You lean against that level, you lean against that area, and you make sure you remember about the area. That just becomes that level, doesn't it? And that bottom of the box just becomes your stop. It's the same thing, but it's a systematic approach to doing business on these things without giving up on a level, without saying, I've had enough, I'm not doing any more, I can't see it. But you can understand that this is why we trade like this. This is why you should be trading the actual process systematically as much as possible, because it gives you some confidence to just get in there and do whatever you need to be doing. It's really not that difficult. And you can see that the gold's over $4,000 profit on that phase of trading using some sort of systematic process. Now, as I said, we haven't used any value on gold, but you can improve on that by using value. The whole point was that we told you that value was higher during this process, didn't we? We told you that the value line was up. So you're obviously going to be looking at that saying, well, I want to be buying it. I don't want to be selling it. So I'm not going to sell the breaks lower. I'm not going to get taken into a stupid breakout lower. I'm just going to wait for the commercials to buy it lower, and then I'm going to buy it against their lean, and I'm going to buy it against their lean, and I'm going to buy it against their lean. Is that not sense? It's exactly what we teach. You buy against the commercial lean, you sell against the commercial lean in a bullish market or in a bearish market. So when you think about that process, it's really not that difficult to kind of figure out what you could be, should be ultimately doing. And look at what's happened to this buy trade, guys. It's just went 50.5 to 55s. Is that not just buying a bottom edge like we teach? Is that not just a process that we go through time and time again about getting your trade on and getting your entries and getting your stops and getting your process and getting everything lined up? And you might say, but the volume's now declining. I could manage that position out. Well, you could, absolutely. And how are you going to get back in? I'm going to wait for the next commercial opportunity. I'm going to wait for the next value to set up. Okay, good. So in other words, you've got a systematic approach to setting up your RGLs, haven't you? But that buy trades just went 50.5 to 55s. $450 on your exit. So you say, right, I'm going to exit here. And you say, right, okay, $450. Now what I'm looking forward to is I'm looking forward to your next trade, aren't you? I'm looking forward to knowing what your next trade's going to be. 450 notes. Since that phase, that's $110, $110, $400, $550 from approximately 1430. It's only 10 past 3. And you've made $4, $5, $6, $7, $8, $9, $10, $1,100. Nearly $1,200 on a 2-lot since the last 40 minutes. Systematically. Just systematically using volume, not using value, but volume and value. Obviously, a lot of the times that we tied in, the value will be going higher, so that's why the volume comes in lower, and so on and so on. And that's the process. Because it's just a 15 ticks, Steve. 50.5. If we know that 50 is going to be liquidity, right? Because everybody knows 50 is going to be liquidity in every market. It doesn't matter whether it's gold or oil or the pound or anything else. So we know that 50 is going to be liquidity. So I don't want to buy at 51s. It's too big a stop I'm going to have to use. So if I buy at 50.5, it means they've rejected the 50, correct? But it's also enough room for me to see that they've rejected the 50. In other words, I'm not going to put it at 50.1 or 50.2. I'm going to put it at 50.5. Now, why can't I put it higher than 50.5? Because at 50 liquidity, I know that the liquidity could probably be about 10 ticks to the other side. If your knowledge of gold would suggest that the maximum stop run usually is 10 ticks. So you want to build that knowledge into that trade, don't you? So the knowledge of 10 tick stops would suggest that the stop should be 49 and the entry should be 50.5. The stop should be 49, the entry should be 50.5, and that's your trade, and that's all you do now. There's no other way around this. This is your deal. I need to make sure I always have a buy stop in at 50.6 and a stop at 48.9. And that's it. As soon as that 49 breaks, I'm out. I don't care what else is happening, I'm out. And in the meantime, I've got a buy stop order at 50.6. I may decide to reduce my RGL. I might decide to reduce my RGL because there might be a very, very strong lean that I can get against something else. If I see a very strong lean, I might bring my RGL down to say 48, 48 and a half, and I go again into that phase. I go again into that long phase. But it's up to me where I now take this, right? It's up to me how I now evolve from this process. This is what we kind of try and do. No, it's not going to be the top of the candle. We're not going to be playing. We're not going to be playing those games. We're just going to go price games. Traders don't trade tops of candles. Locals don't trade tops of candles, do they? Because they don't know what the bloody candle is. If you're a local in the pit, you don't know that the candle high was 49.7. You know that the price was 49.7, so you're going to say, right, well, 49.7, I'm going to go 50. I'm going to go bid at 50. So it gives you that idea of an RGL. That's why the RGLs are always rounded to the nearest kind of wholesale price most of the time. So you can see at the top edge, the RGL's rounded to 55 evens and 53.5. At the bottom edge, it's rounded to 50.5 and 49s. So we're just rounding it around an area, wrapping it around an area so that we can trade this, right? Around an area so that we can trade this, right? But every single trade has got the same ability for you to then do another phase. This is the systematic approach to trading, isn't it? This idea that every time we take a trade, we try and understand this idea, this approach. Because it's all about that volume, isn't it? At the end of the day, it's all about the volume. It's all about what you see next happening, what you're going to be doing next. You know, I was looking at selling oil, but I never sold oil. Why? Because the euro-dollar went higher. So I'm not going to be stupid enough to put an RGL into a sell when the euro-dollar is going higher and the break-evens are going higher again. But as soon as that break-even starts dropping, as soon as that euro-dollar stops dropping, guess what? I'm going to put in an RGL on oil. It's a sell side only RGL, so it's not really an RGL, but it's the same. I'm trying to get across, it's the same process. It's a systematic way of trading a top edge. If I think the price is going to go higher, I'm not going to use that RGL, right? I'm not going to use that RGL. So I start looking for that oil short. I start working my sell orders against that short oil position. And obviously my job is to make as strong a position as I can. That's the whole point. So we do use value, absolutely, Paul. We absolutely use value, but we use value inside the world of the systematic entry process. So when we do that, suddenly magic happens. Seriously, magic happens. Because you find that you're always in trades. And if you're always in trades, guess what happens? You catch the big winners. You catch the big winners. It should take a lot for you to close off a systematic trade because you're taking a manual override, right? And a manual override is a different kettle of fish altogether, isn't it? Understand?